Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Friday, July 24, 2026. We're Elena and Marcus. This episode is brought to you by Bank Atlas, where the risk of every bank is quantified via proprietary grades and analysis. Learn more at bankatlas.com.
So diving into our daily desk data this week, we are looking at a market that is just navigating some really extreme cross currents.
Yeah.
To say the least.
Right. If you're looking at your portfolio right now and wondering why your big tech stocks are bleeding while, your standard energy dividend stamps are surging, you're basically feeling the underlying turbulence of today's data deck.
Which is exactly what we need to break down for everyone today. So we've got three critical themes jumping out from the latest numbers.
All right, three main ones.
First, there's this massive geopolitical inflation shock happening in real time, which is driving some pretty severe volatility in crude oil.
Second, we're tracking a really violent under-the-hood rotation in equities. The market is aggressively punishing tech and rotating straight into defensive sectors and real assets.
Yeah, that rotation is fierce.
It is. And third, we're facing a highly complex setup for global interest rates as we head into, a very pivotal Federal Reserve meeting next week.
Correct. And if we start with that macro picture, everything really hinges on that geopolitical inflation premium right now.
Right, the conflict between the U.S. and Iran.
Exactly. It's entering its fifth month now. And we are looking at a scenario where the Strait of Hormuz has been effectively closed to normal commercial traffic since March.
Which is just a massive disruption.
It is. It's not just a passing headline, you know. This is a severe geographical bottleneck that disrupts a huge percentage of global daily crude consumption.
And we really saw the climax of that bottleneck in the energy markets this week. Brent crude temporarily breached $100 a barrel.
Yeah, it spiked hard.
It did, before retreating back to around $98 based on some faint diplomatic signals. But that brief breach of the century mark, that sends ripples through every single asset class.
Indeed. Global bond markets are actively absorbing this inflationary threat right now. If you look at today's data deck, the 10-year Treasury yield is up roughly 10 to 12 basis points on the week.
So it's sitting right near 4.68%.
Right. And when we look at the shape of the yield curve, the steepening there is highly informative. For our latest run, the 5-year, 30-year spread is elevated at positive 73.3 basis points.
Okay, wait, let's pause there for a second. For a regular investor listening to this, how does that steepening curve actually impact them? Can you give us a simple analogy for what this stagflationary data and these rising yields actually mean in the real world?
Yeah, sure. So think of the U.S. economy right now like a house during a severe summer heat wave.
Okay, a heat wave.
Right. And the Federal Reserve is the air conditioning unit. They are keeping interest rates high currently at 3.75% to, systematically cool down the house and bring inflation back to their target.
Makes sense.
But this geopolitical oil shock with Brent crude flirting with $100, that is basically like someone leaving the front door wide open.
So letting all the heat back in.
Exactly. It lets all this external, unavoidable inflation blast right back into the house. So the consumer is trapped paying this massive inflation tax at the gas pump, and the Fed is trapped keeping the AC blasting, meaning they maintain those restrictive borrowing costs because they're terrified of the heat taking over.
Right. So for regular investors, your credit card rates and mortgage costs remain high exactly when your baseline cost of living is spiking.
Yeah, that's exactly the mechanism at play. They're anticipating that this energy shock will not resolve cleanly or quickly, which embeds a sticky, long-end inflation premium into the bond market.
Which brings us directly to the domestic economic data we received this morning. The U.S. Services PMI data, which tracks purchasing managers in the service sector, came in at 53.6.
Right, and anything above 50 means expansion.
So the underlying economy is technically still growing, but looking at our daily desk data, the detail that matters most is that the output prices within that PMI report just rose to their highest level since August 2022.
Yeah, businesses are paying more to operate.
And they're passing those costs directly onto the consumer.
That is the defining data point of the day. You have resilient economic activity coupled with reaccelerating price pressures, and that puts the Fed in a highly uncomfortable position. Current market pricing implies a 37% probability of a July rate cut.
But the institutional consensus base case is pointing heavily to a hawkish hold at 3.75%, right?
Correct. The Fed basically refuses to cut rates while that front door is open.
Moving to today's data, Because those interest rates are elevated and inflation fears are back in the driver's seat, we are seeing a violent rotation beneath the surface of the stock market.
We really are.
If you just glance at the headline index, you might think it was a remarkably boring week. I mean, the S&P 500 was roughly flat to down 0.6%, but that headline number just completely masks the internal chaos.
The divergence is stark. The equal weight S&P 500 index outperformed the cap-weighted index by positive 73 basis points today alone.
Which is a massive under-the-hood signal, because the standard S&P is cap-weighted, meaning the mega-cap tech names dictate the direction.
Right.
So if the equal weight treats all 500 companies the same, and it's outperforming by that much, it tells us the average stock is rising, but big tech is dragging the whole headline number down.
Yeah, and the sector winners from our latest run perfectly illustrate this defensive shift. Real estate, tracked via the XLR ETF, was up 2.2%. Materials, tracked via the XLB, was up 1.9%.
So investors are clearly hiding in physical materials and defensive dividend yields.
Exactly. They are trying to protect themselves from that open-door inflation heat wave we just talked about. And then you look at the sole decliner, the technology sector.
Dragged down entirely by the semiconductor complex.
Yeah, the SOX index dropped 4.3% intraday. And we're seeing heavy international contagion, too. The Asian markets are feeling it, with the KOSPI dropping 5.7% amid a broader rout.
We have to name the specific corporate movers here, because the price action on earnings is incredibly telling. Alphabet, GOGL, dropped 8% on the week. Alphabet essentially told the market, great news, our cloud division just grew 82% year over year. But then they followed it up with, we need to spend $200 billion on infrastructure to keep doing it.
And the market collectively choked on its coffee.
Yeah, Alphabet was severely penalized solely because they raised their 2026 AI CapEx guidance to $195 to $205 billion.
It is an incomprehensible amount of capital. We're talking about the GDP of a small nation being directed entirely toward data centers and high-end chips, and they weren't the only ones punished.
Right, Tesla.
Yeah, Tesla TSLA dropped 20% on an EPS miss, combined with rising fears over their shrinking profit margins.
And Intel, INTC, dropped 7.9%. But what's notable there is they dropped despite issuing strong forward guidance.
Right.
Let me challenge the data here for a second, because our proprietary updates show a clear contradiction. 85% of S&P 500 companies have beaten their earnings estimates so far this season. That is the highest beat rate in 5 years.
Yeah, the numbers are strong.
So if corporate results are historically great, why is the average tech stock getting hammered on earnings day? Why are investors so aggressively selling the news?
Well, it comes down to extreme crowding and tech positioning and a rising skepticism around the sustainability of all these AI capital expenditures. For the past year, institutional portfolios have been universally overweight on technology.
So everyone's on one side of the boat.
Exactly. When everyone is already long, even fantastic news isn't enough to bring in new buyers. There's no one left to buy. It just becomes an opportunity for current holders to take their profits and step away.
Especially when they see a $200 billion CapEx bill from Alphabet.
Right. Investors look at those servers and chips, which become obsolete in a few years, and ask, when does this massive spend actually translate to free cash flow?
Which perfectly explains the institutional flows we're seeing. Hedge funds are aggressively buying the energy sector for the 6th straight week, while simultaneously dumping consumer discretionary and consumer staples. They know the consumer will struggle with discretionary purchases when oil surges, so they're buying the very commodity causing the pain.
On that point, the defensive positioning we are seeing in equities perfectly mirrors the action we're tracking in physical commodities and hard assets.
Right. Let's talk about Brent crude's wild intraday reversal. It dropped roughly 4% from its peak to settle near $98 today.
But it still remains on track for a 10% weekly gain.
Yeah, the physical market is heavily pricing in that supply disruption from the Hormuz closure.
And hard assets are catching a strong bid as inflation hedges. Gold is holding firm above that key $4,052 per ounce level. Silver is up 1%.
Silver gets that dual demand, right? Industrial use plus the safe haven bid?
Correct. But then you look at copper and it remains flat, which is acting as a major warning sign regarding demand uncertainty in China.
If copper isn't moving, physical infrastructure building is stalling.
Yeah, which is why energy equities remain so highly favored right now by institutional consensus. Name drop Chevron, CVX, and ConocoPhillips Cup. They are consensus buy recommendations because of their robust free cash flow.
Right. Our latest run shows ConocoPhillips showing an 18% total return potential.
Understood. But we need to connect all these simultaneous moves across rates, equities, and commodities to identify the current market regime.
The synthesis.
Yeah. Dealer desks are calling this a triple threat regime. First, you have surging oil prices. Second, peak AI capex fears. And third, a massive supply glut of securities.
The supply glut is huge. We're seeing a flood of IPOs, plus $489 billion in AI-related debt issuance year to date. The market has to digest all this new paper.
But despite that, credit markets aren't panicking. The investment-grade CDX spread remains contained at 53.5 basis points, and high-yield your BB and CCC paper is elevated but calm at 315.8 basis points.
So corporate balance sheets are fundamentally fine.
Exactly. The equity sell-off is highly sector-specific to tech. It's driven by geopolitics, not systemic credit deterioration.
So it's a valuation reset. Which leaves us with a provocative thought for the listener. If back-channel diplomacy between the U.S. and Iran succeeds next week and oil retreats back to the 80s, does the semiconductor rotation violently snap back? Or is the market's new skepticism toward AI capex now a permanent structural ceiling for tech valuations?
That is the big question for next week. Just to quickly recap today's core takeaways. We're navigating extreme oil volatility, a stubborn Fed stagflation dilemma, and a violent tech-to-defensives equity rotation.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market color. Have a great weekend.